Knowledge is power when it comes to investing. To paraphrase Ben Graham's financial counsel, you should endeavor to understand what you are doing and why you are doing it. Don't play if you don't comprehend the game. Keep your distance till you do. If you're thinking about starting an income portfolio, this video will help you get started. This entails building a portfolio of income that will meet your financial demands long after you stop working. But this isn't a get-rich-quick plan. In reality, we believe that the best investments need patience and common sense. Important takeaways: inflation and market risk are two of the most important risks to consider when investing. Dividends are popular among investors because they provide consistent income and are a secure investment. Investors should research potential companies and hold out till the pricing is correct. As you build, diversify your assets to include a wide range of equities from various industries. Inflation is a scourge. Inflation and market risk are two of the most important risks to consider when investing. Investors are always exposed to both, in various degrees depending on the asset mix of their portfolio. This is the crux of the problem for income investors: how to generate income while avoiding undue risk. At 5% interest, a $1 million bond portfolio will offer an investor with $50,000 in annual income, while also protecting the investment from market risk. However, assuming a 3% inflation rate, the investor will only have roughly $35,000 in purchasing power in today's dollars after 12 years. With a 30% tax rate, $50,000 in pre-tax and pre-inflation, adjusted income becomes slightly under $25,000. Dividend fundamentals. Dividends are quite popular among investors, particularly those seeking a consistent stream of income from their investments. Some businesses prefer to distribute profits to shareholders. Dividends are the name given to these distributions. The amount, method, and timing of dividend payments are established by the board of directors of the corporation. They are often distributed in the form of cash or more company stock. Dividends can be paid even if a company does not generate a profit, and this is done to maintain the company's track record of delivering regular payments to shareholders. The majority of businesses that pay dividends do so on a monthly, quarterly, or annual basis. Dividends are classified as either regular or extraordinary. Dividends are given out on a regular basis. Companies pay these dividends with the expectation that they will be maintained or increased in the future. Regular dividends are distributions made from the profits of the company. Special dividends, on the other hand, are usually given out only once after reaching particular milestones. Companies may choose to reward shareholders with these payments if results exceed forecasts or if a company unit is sold. Why dividends? For a variety of reasons, many investors include dividend-paying companies in their portfolios. For starters, they give regular income to investors on a monthly, quarterly, or annual basis. Second, they provide a sense of security. Stock prices are volatile due to a variety of variables, including company-specific or industry-specific news, as well as factors affecting the wider economy. So investors want to ensure they have some stability as well. Many dividend-paying corporations already have a track record of success and profit sharing. Non-guaranteed dividends and economic hazards are two of the risks associated with an equity portfolio. Assume that instead of investing in a bond portfolio, like in the preceding example, you invest in healthy dividend-paying shares with a 4% yield. These stocks should increase their dividend payout by at least 3% per year, which would cover inflation and likely grow at 5% per year over the next 12 years. Important equity portfolios come with risks involving non-guaranteed dividends and economic risks. If the latter occurs, the $50,000 revenue stream would increase to over $90,000 per year. At the same 3% inflation rate, that same $90,000 would be worth roughly $63,000 in today's dollars. After the 15% dividend tax, which is also not assured in the future, the $63,000 is worth around $53,000 in today's money. That's more than double the rate of return generated by our interest-bearing portfolio of CD and bonds. A portfolio that combines the two strategies has the capacity to resist both inflation and market swings. The tried and true strategy of investing half of your portfolio in stocks and half in bonds has appeal and should be examined. As an investor gets older, his or her time horizon shrinks and the need to outperform inflation reduces. A higher bond weighting is appropriate for retirees, but for a younger investor with another 30 or 40 years before retirement, inflation risk must be addressed. If this is not done, it will chip away at one's earning ability. A great income portfolio, or any portfolio, takes time to create. As a result, unless you locate companies near the bottom of a bear market, there are likely to be only a few suitable income stocks to buy at any given moment. It's fine if it takes 5 years of shopping to find these winners. So, what could be better than having your retirement paid for by dividends from a blue-chip stock with a high dividend yield? Owning 10 of those companies, or better still, 30 blue-chip corporations with significant dividend yields. Motto: safety first. Remember how your mom told you to look both ways before crossing the street. The same principle applies here. The easiest time to avoid risk in investing is before you start. Before you even start buying into investments, set your criteria. Next, do your homework on potential companies and wait until the price is right. If in doubt, wait some more. More trouble has been avoided in this world by saying no than by diving right in. Wait until you find nice blue chips with bulletproof balance sheets yielding 4 to 5% or even more. Not all risks can be avoided, but you can certainly avoid the unnecessary ones if you choose your investments with care. Also, beware of the yield trap. Like the value trap, the high yield trap looks good at first. Usually, you see companies with high current yields, but little in the way of fundamental health. Although these companies can tempt investors, they don't provide the stability of income that you should be seeking. A 10% current yield might look good now, but it could leave you in grave danger of a dividend cut. Setting up your portfolio. Here are the 6 steps to guide you in setting up your portfolio. 1. Diversify your holdings of high-quality stocks. Keep in mind that you are investing for your future financial needs, not to turn your money into King Solomon's treasure. Keeping this in mind, leave the ultra-focused portfolio management to the guys who live and breathe equities. Dividends, not growth, should be the primary goal. You do not have to put your company at risk. 2. Spread your weighting over 5 to 7 industries. Having 10 oil firms seems good until oil goes below $10 per barrel. Dividend stability and growth are the top priorities, thus you should avoid dividend cuts. If your dividends are reduced, check sure it isn't an industry-wide issue that affects all of your holdings at once. 3. Choose financial stability over growth. Having both is best, but if in doubt, having more financial wherewithal is better than having more growth in your portfolio. This can be measured by a company's credit ratings. The Value Line Investment Survey ranks all of its stocks in the Value Line Index from a plus to a D. Focus on the as for the least amount of risk. 4. Find companies with modest payout ratios. This is dividends as a percentage of earnings. A payout ratio of 60% or less is best to allow for wiggle room in case of unforeseen company trouble. 5. Find companies with a long history of raising their dividends. Bank of America's BAC quarterly dividend yield was just 0.1% in 2011, when it paid out $0.01 per share. 10 years later, the dividend yield has increased to 2.2%, with a $0.21 quarterly dividend in 2021, a 20x increase. That's how it's supposed to work. Good places to start looking for portfolio candidates that have increased their dividends every year are the S&P Dividend Aristocrats list and Mergent's Dividend Achievers. The Value Line Investment Survey is also useful to identify potential dividend stocks. Companies that raise their dividends steadily over time tend to continue doing so in the future, assuming the business continues to be healthy. 6. Reinvest the dividends. If you start investing for income well in advance of when you need the money, reinvest the dividends. This one action can add a surprising amount of growth to your portfolio with minimal effort. In conclusion, while not perfect, the dividend strategy gives us a better chance of outperforming inflation over time than a bond-only portfolio. It is preferable if you have both. The investor who seeks a safe 5% return with no risk is attempting the impossible. It's like seeking for an insurance policy that will cover you no matter what happens. It doesn't exist. Due to low but consistent inflation, even hiding cash in the mattress will not work. Investors must take risks, whether they like it or not, since the risk of inflation is already present, and the only way to overcome it is through growth.